3, and we extend our overall understanding on the earlier project that we were looking at for future retail, and now take it towards the cash flow view of the project. So we have to return back to our future group project. The cash flow will give another, it's a cash flow view will give another way to evaluate this, which is the net present value way, or find the present value of all future cash flows, right? There are a few sets of changes or adjustments that we need to there. From accounting adjustments point of view, we have to add back all the non-cash expenses that we have already accounted for. We have to make adjustments for capital expenditure, and we have to make adjustments for the working capital that come in, right? These are three of the key adjustments that need to be done. Now, there are some key points that we have to note and talk about. The first one is depreciation. What do we mean by depreciation? Depreciation is essentially the write-off or wear and tear in each asset's value that we are doing year on year. And it actually gives a tax benefit. It's a cash flow benefit for us. Why? Is because it reduces pre-tax profit. It is not exactly a cash outflow, right? So tax value goes down. So let's say if I have a pre-tax operating profit of 100 and I have a depreciation of 20, I pay tax only on 80, assuming no interest, right? That will be 24. So technically I'm left with 56 plus this 20. This 20 never went out, right? So I'm with 76 here. Now, what that means is essentially I'm left with 76 rupees here. And otherwise, if I had taxed the entire 100, I would have been left with 70 rupees with a 30% tax rate, right? So effectively, this extra 6 that I get is because of depreciation. Now, what is important is to understand is depreciation is straight line or accelerated. In straight line, over 5 years, I will just take 20, 20, 20, 20, and hence my cash would be 76. In accelerated, I could take 40 in the first year. So I get 60. 60 will take a tax of 18, give me 42. To this, I will add back the 40, right? So if I take a depreciation, accelerated depreciation, it will reduce profits because my profits are now 42 instead of 56 earlier, correct? That's because the pre-tax profit has gone down, and hence the total profitability will be lower, but it will increase cash flow since there will be a lower outflow of tax. Tax earlier was 24, remember. So 24 minus 18 is going to be 6. That's why instead of 76, I end up with 82, which is 76 plus 6. That 6 is what we saved on account of lower tax payment, right? So if a company is following accelerated depreciation, a lot of the times it would be cash flow positive for you in the near term. In the long run, it obviously matches itself out because what if you pay lower tax today, you'll have to pay higher tax later on at some point of time, correct? The Capex, capital expenditure, could be again divided into two parts. One is called the growth Capex, which is in any assets that are going to add future growth to your overall company. And building a factory, building another resource, etc., is all that is going to come under this. The maintenance capex, on the other hand, is essentially the wear and tear you essentially take every year, right? That's basically usually in all our project evaluations the amount of depreciation that is there. Maintenance capex increases with the tenure of the project. Longer the tenure, more the maintenance capex that's going to come. All capital expenditures would mean reduction of cash flow, right? The third adjustment we have to make is for working capital. Increase in working capital, increase in receivables, increase in inventory, etc., will mean more current assets, thus will mean more cash blocked and is cash negative for the business. Remember, we have discussed increase in CA is negative. We have to subtract an increase in CA's current assets, right? That's what we have to kind of take care of. Let's go to our Excel file and try and plug in these numbers. So that's our Excel file. We know that to profits, we have to add depreciation, then we have to subtract capex, and we have to change net working capital, right? So where are the profits? The profits are available here, operating profit after taxes, right? Depreciation is available here. I can take the depreciation values from here, right? Less capex, capital expenditure that we have done. So capex is available as the sum of all these three, right? So I can write sum of these three.